Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instinct. On Thursday, January 29th, 2026, the market finally asked the question it's been dodging for months. Not is AI big? We know that. The real question is, at what point does the cost of AI start cannibalizing the companies building it? On the surface, the major U.S. indices looked steady. The S&P 500 barely slipped. The Dow pushed into record territory. But beneath that calm, today was a violent rotation day. Microsoft erased more than $350 billion in value. Meta exploded higher. And the tape quietly shifted from rewarding AI potential to demanding visible, high-margin AI performance. Look at the S&P 500 heat map, and the story jumps out. A mostly green board, roughly 2/3 of the index higher, but with a few screaming red landmines. Communication services glows. Meta's box lit up bright green. Alphabet solidly higher beside it. Semiconductors and hardware lean green as well. Nvidia and several chip names quietly up. Banks, industrials, and integrated energy? Broadly positive, giving the screen a cyclical pro-growth feel. Now the damage. Software is the killing field. Microsoft, a giant red block. Salesforce, Palantir, and peers under pressure. Tesla stands out as a deep red anchor in consumer discretionary. Net result. The heat map doesn't show a market in retreat. It shows a market aggressively reshuffling who leads. That heat map leads straight into the money flow. Capital came out of the high multiple enterprise software and crowded growth trade. Microsoft's roughly 10% hit triggered selling across the broader software complex. Salesforce, Palantir, and others felt it. At the same time, money rotated into platforms and cyclicals. Meta and Alphabet on the internet side. Semiconductors as the core AI hardware trade. Banks and diversified financials. J.P. Morgan, Bank of America, Visa, Berkshire, all traded well, signaling comfort with the macro backdrop. Industrials and energy pushed higher, with names like Exxon stretching to fresh highs. Defensives, utilities and staples were only mildly bid, so this wasn't a flight to safety. It was a rotation within risk, away from expensive cloud and software exposure, toward platforms and real economy sectors, where AI and growth already show up in cash flow. Put it all together, and today didn't feel like the end of the AI bull market. It felt like an audit. The S&P 500 slipped only a touch. The Dow even finished green. Breadth was decent, small caps held up, so this wasn't broad de-risking. Instead, investors started grading AI strategies in real time. Who's spending billions with a clear payback? Who's asking shareholders to fund open-ended infrastructure on faith? That's why Microsoft's roughly 10% drawdown, one of the largest single-day value losses ever, didn't break the tape. The market simply repriced the pecking order of AI leaders. From here, the message is clear. AI is still the core theme, but access to capital will favor business models that can show the receipts. On the desks, the chatter got more speculative. Traders passed around comments that a big chunk of Microsoft's cloud AI backlog may be tied to OpenAI. Not confirmed, but enough to spark talk about concentration risk. Just how dependent some big tech names might be on single AI partners. At the same time, everyone was debating the AI CapEx arms race. Meta talking $100+ billion of spend over the next few years. Microsoft ramping hard as well. The open question, does this become a margin squeeze across big tech? Or just a front-loaded investment cycle before a long monetization runway? That debate helped explain the sharp divergence inside mega-cap AI names, and it kept volatility elevated in semis and cloud infrastructure, even as the broader market held together. Microsoft's sell-off looked completely counterintuitive. Revenue up roughly 17%, EPS up more than 20%. By traditional standards, this was a near-perfect earnings report. But the market wasn't asking, is Microsoft growing? It was asking, how much will AI really cost, and when does it pay back? The real concern wasn't demand. It was capital spending. Massive data center build-outs, accelerating AI investment, and a return timeline that's still unclear. That explains why the stock didn't rally. But it doesn't explain why it fell more than 10% in one day. The real driver was the options market. Microsoft is one of the most heavily traded names in so-called zero DTE, zero-day options. When the stock slipped below key option strikes, market makers were forced to sell shares to hedge risk. That's negative gamma. As price falls, hedging forces more selling, turning a pullback into a cascade. Under the zero DTE feedback loop, sentiment didn't just shift, it accelerated. So Microsoft didn't crash because it failed. It fell because AI optimism collided with modern market structure. And this is how markets really move now. Meta sat on the other side of today's paradox. The stock surged more than 10% after a strong fourth quarter beat. Revenue and EPS came in ahead of expectations. An aggressive AI infrastructure plan running into the hundreds of billions over the next few years. But crucially, that spend is tied to something investors can see right now. Better ad targeting, higher engagement, stronger revenue guidance. On a day when the market punished AI capex without a clear payoff, Meta became the poster child for the good AI spend. Its strength lit up communication services on the heat map and helped offset software's damage at the index level. Message from the tape. If your AI budget is clearly monetizing, the market will still pay up. While Microsoft was melting and Meta was ripping, Apple played stabilizer. The stock drifted modestly higher into its after-hours report, as investors treated it as the lower volatility corner of mega-cap tech. By the time the bell rang, the narrative for the day was already in place. AI spend was on trial. Then, Apple posted a post-close beat, driven by strong iPhone demand. That didn't rewrite the AI story, but it did reinforce a key subplot. In a market suddenly obsessed with execution, cash-generative franchises with clear, product-driven demand still command a premium. Apple helped keep the broader mega-cap complex from feeling like a one-way liquidation. NVIDIA quietly passed a big test today. On a session dominated by Microsoft's collapse, NVIDIA finished modestly higher. That resilience, especially with its largest cloud customer under heavy pressure, matters. It tells you the market still sees GPUs, the hardware bottleneck of AI, as a core beneficiary of the CapEx wave. Investors may be re-rating which cloud and software names deserve premium multiples, but they're not backing away from the semiconductor plumbing that makes this all possible. Today reinforced the software tilt as the preferred way to own the AI build-out. Tesla had a rough day in a tape that wasn't universally bad for growth. The stock dropped several percent, extending its post-earnings slide. Concerns about margins, competition, and electric vehicle demand stayed front and center. The important part is the contrast. Semis held up, some AI platforms rallied. But Tesla, one of the market's core high beta sentiment names, just couldn't catch a bid. That underperformance is a tell. When investors start auditing execution and cash flow, long-duration narratives without near-term earning support get treated very differently. Away from the AI fireworks, ExxonMobil kept climbing. The stock pushed to new 52-week highs, helped by firm energy prices and ongoing optimism around cash returns and capital discipline. Its strength fit perfectly with the day's rotation pattern. As investors questioned pricey software, they leaned into sectors tied to real economy demand and tangible cash flows. Energy, led by integrated majors like Exxon, became a quiet beneficiary. That's the other pillar of this market right now. AI on one side, and disciplined, cash-rich cyclicals on the other. Lockheed Martin added another dimension to today's rotation. A stock rally to new highs after strong fourth-quarter results and news of a large missile defense deal. Volume was strong. Other defense names traded well alongside it. In a market obsessed with AI headlines, this is the quieter story. Institutional money is steadily building exposure to defense, energy, and select industrials as long-duration themes. Lockheed's breakout underscored that defense is becoming a second structural pillar of this bull market, complementary to AI, not competing with it. So where does this leave us heading into the next stretch? We're no longer in the phase where AI in the slide deck is enough. The market is moving from AI storytelling to AI scorekeeping. Upcoming macro prints on manufacturing services and the labor market will shape how comfortable investors feel owning cyclicals and financials. More mega-cap earnings will test today's pattern. Do we keep rewarding companies that can show direct return on their tech spend? Do we keep derating those where CapEx ramps faster than monetization? The path of this rotation, whether it stays orderly or turns into something bigger, will hinge on execution, not just narratives. To wrap it up, today showed a market that's still willing to take risk, just not blindly. The broad bull trend stayed intact, even as one of its biggest generals stumbled hard. Leadership is shifting toward companies that can prove their spending, not just pitch it. AI remains the headline act, but defense, energy, and select cyclicals are clearly sharing the stage. As we roll into the next session, the core question doesn't change. In a world of massive AI budgets and tight capital, who can actually turn investment into earnings? That's who this market is prepared to reward. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.